So, good morning. So you are to conclude something on the debtors or account receivable payment or collection period. So remind me the last question that we did. So what was the last question that we did? Just a reminder, let me know the last question that we did. So I'm told you are to do November 2017, question 1, part D. So you are to do the question for November 2017, question number 1, part D. So we can go through that question for November 2017, question number 1, part D. So the question reads that question reads that. So the management of Kumbo Limited, the management for Kumbo Limited intends to change the company's credit policy from net 30 to 3/10 net 60 to 3/10 net 60. So if this change is effected, annual sales are expected to increase by 25%. They were expected to increase by 25% from the current level of shillings 12 million. So the proportion of the bad debt is also expected to increase from 10% to 15% of the credit sales. From 10% to 15% of the credit sales. Then new credit assistant officer, the new credit assistant officer will also have to be employed at a salary of 500,000 per annum. So if there is a change in the firm's credit policy, it is expected that 60% of the credit customers will benefit from the cash discount offer. They will benefit from the cash discount offer. So the inventory level and the variable costs are, however, expected to remain constant. At 20% and 40% of the annual sales, respectively. The firm's rate of return on investment is 14%. The firm's rate of return on investment is 14% per annum. So the corporate tax rate is 30%. All sales are on credit. Assume a 360-day financial year. So now required advise the management of Kumbo Limited on whether to adopt the new credit policy. So we simply prepare the income statement. We should be able to prepare the income statement. Simply prepare the income statement where we come up with before the change and also after the change. So this is now our income statement. That is now the income statement. So in the income statement, we should be having before the change. We should be having before the change, and also after the change, and also after change. So we prepare the income statement before the change in the policy and also after the change in the policy and also after the change in the policy. So we start off with the revenue. So the question we are doing, you remember the question? It was November 2017, question 1D. November 2017, question number 1, or what D. So we start off with the sales revenue. We start off with the sales revenue. Start off with the sales revenue. So sales at the moment, when you check through the sales at the moment, they had given you that information in the first paragraph that annual sales are expected to increase by 25% from the current level of sales of 12 million. So currently the sales are 12 million. So they are meant to increase by 25%. So we get 125%. 125% of that figure of 12 million. So when we increase that sale by 25%, so what is 125% of 12 million? You are getting exactly 15 million. Yeah. So that now should give you the value for the sales. So we are supposed to less the variable costs. We need to less the variable costs. So to get the variable cost, when you go to the question, in the before on the next, so inventory level and the variable cost are however expected to remain constant at 20% and 40%. So variable costs are 40% because inventory is 20%. So variable cost, we less variable cost. So you get 20%, so you get 20%. So no, 40%. Variable costs are 40%. 20% is the inventory. So get 40% of the sales. Get 40% of the sales. Get 40% of the sales. So what is 40% of 12 million? $4,800. So this one will be 4,800. Then also get 40% of the 15. So when you subtract When you subtract, we now get the contribution. Subtract. We shall now come up with the contribution. When we subtract, we shall now get the contribution. So what we have there as our contribution before the change. Sorry? 72. And after so that now gives you the contribution. So we less now the expenses. We less now the expenses. Minus expenses. So among the expenses, there are bad debts. So at the end of the first paragraph, they say that when you check at the end of the first, the proportion of the bad debts is also expected to increase from 10 to 15 of the credit. So we assume all those sales are on the credit because they have not given the proportion for the credit. So we start the bad debts. We start off with the bad debts. So that bad debts, the first one should be 10%. So it is 10% of 12 million. It is 10% of 12 millions. So this one will be 1200. So this other one, it is 15%. So that is now the bad debts. So apart from the bad debts, when someone who is employed in the next paragraph, they have said that a new credit assistant officer will also have to be employed at a salary of how much? 500. So that salary was not there before. It's not there. So there is so before it is not there. But after they are employing that person, at 500. 500,000. So we have the value for that. So someone is asking about the variable cost. So they had given you in the last paragraph, they had said that inventory level and the variable cost are, however, expected to remain constant at 20% and 40% of the annual sales respectively. So there are 2 percentages there. 20% will be for the inventory. The variable cost is 40%. So you simply get the 40% of the sales to give you the figure for the variable cost. When you want to get the variable cost, you simply get 40% of the sales. And that information is given in the last paragraph. Are you able to see that part? Yeah, so apart from now the bad debts and the salary, there is another cost. There is another cost that was incurred, expense. This one is the discount. This one is the discount. This one is the discount. So when we started this part, when we were discussing some questions, there is a term that is given at the end, so at the start of the question. there is a term that is given at the start of the question. You can see at the start of the question, they said that the management of Gumbo Limited intends to change the company's credit policy from net 30 to how much? You can see 3/10 net 60. Now that term 3/10 net 60. I hope all of you have seen that term. Have you seen that term, all of you? Those who are online, can you see that particular term? So if you have seen it, the numerator, the 3 is normally the discount rate. The 3 is normally the discount, and it is always a percentage. That 3 is the discount rate, and it is always a percentage. That means the discount rate is 3%. Then that 10 refers to the discount period. The 10 will be able to refer to the discount period. Then 60 is the credit period. So always remember that when you get that term, 3/10 net 60, it means that 3 is the discount rate, 10 is the discount period, 60 is the credit period. Always recall that. So before, it was not there. When you check through the first paragraph, they have said that it intends to change the company's credit policy from net 30 to 3/10 net 60. So before, it was not there, but after, it is 3/10 net 60. Then when you continue to the question, they said that now after the salary, if there is a change in the firm's credit policy, it is expected that 60% of the credit customers will benefit from what? The cash discount. So the discount rate, so before, there is no discount. But after, the discount rate is 3%. 3% of the 60% of the 15 million. Because they are saying that we assume all the sales are on credit. But those who qualified for the discount, it is 60%. So get 60% of 15 million. You get the 60% of the 15, then get 3% of that. Then get 3% of that. You get the 3% of that value. 270. So online, I hope everyone is getting that point. Are we all seeing where we are getting the discount? Before, it was not there, but after, it was provided. So are we all able to understand how we are coming up with the discount? Are we able to see how we are getting the discount? Yeah, people are not responding. I don't know whether it is making sense, because you should be able to know how to get that discount. Are we okay up to that level before we go to the next item? Yeah, so that was now the discount. Then apart from that, we say there is also opportunity cost for the debtors. There is also opportunity cost of the debtors. There is also the opportunity cost of the debtors. I said 3 is the discount rate, not the net rate. 3 is the discount rate. So that term is explained in the handout. If you go to the handout, and I discussed it in the other class, I said when you get this kind of the term, it is 3/10 net 60. So 3 represents the discount rate. 10 is the discount period. Then 60 is it is a term that is used in credit management. It is a term they use in the credit management. When you get such a term, this numerator is the discount rate. The denominator is the discount period. then that 60 is the credit period. That 60 will be the credit period. So that term, you will get it in so many questions. When you get such a term, it simply means that that numerator is the discount rate. The denominator is the discount period. Then the next 60, that 60 is the credit period. So always get to know how to make the interpretation of that term. When you get it in the question, when you get that term in the question, it is one of the terms they use in the credit management. So when you get that term, the numerator there is the discount rate. The denominator is the discount period. Then the credit period like that. So that's now for the discount. The other thing is the opportunity cost. Opportunity cost of the debtors. Opportunity cost of the debtors. Opportunity cost for the debtors, we say that debtors are people who owe you money. The people you have sold goods to on credit. So they have not paid you. If they could have paid you, that money will be in the bank earning you interest. But now that they have paid you, you are losing that interest. That's why it is known as the opportunity cost. If they could have paid you, that money will be earning you interest in the bank. But now that they have paid you, they have not paid you, you are losing that interest. That's why we refer to as opportunity cost of the debtors. Opportunity cost of the debtor. So first you get the average debtors. First you compute the average debtors. So I had shown you how to get the average debtors. The formula of getting the average debtors was credit sales multiplied by the average collection period. You divide by number of days in a year. When you want to get the average debtors, you simply take the credit sales multiplied by average collection period. Then you divide by the number of days in a year. So we assume that all the sales were on credit. We assume that all the sales were on credit. We multiplied by average collection period. So average collection period, they are normally given in two ways. Sometimes they may give it separately. So if they give you average collection period separately, you use the one that they have given you. But this one, we assume the average collection period is the credit period. Is the credit period. So it is given to you in the first paragraph, where they say that they are changing from net 30. So the 30 there is the credit period, which is the same as average collection period before, to 3/10 net 60. So the 60 is also the average collection, but that one is after. But when you get a question, sometimes they can give you the two, the one for the net and the average collection period. So our average collection period, which is now net 30, it is there in the first paragraph. So multiplied by 30, divided by the number of days in a year. Number of days in a year were given to you in the last paragraph, in the last line, as 360. So multiplied by the interest rate. Interest rate is the cost of capital. The cost of capital is what is meant to be the interest rate. So are you able to see somewhere before required? The rate of return on investment. Rate of return on investment is 14%. So now get 14% of that. That will give you the opportunity cost for the debtors. It will be able to give you the opportunity cost for the debtors. So you are getting 140. Online, you let me know the figure you are coming up with. Are we getting 140? Yeah, so that is now before. After the change, our credit sales are 15. Multiplied by average collection period. Average collection period after it is 60 days. Also divide by 360. Get 14% of that. Get the 14% on that. We come up with the 14% of that figure. 150. So it is 350. Are you getting 350? Those who are online, what figure are you coming up with? So compute, you give me the value, we compare with the one I've been given. They are also say 350. Then apart from that cost, there was also inventory. There is information about inventory. So inventory are stocks that you have not sold. You see, when you are in business, there are items that you have not sold. That one is what we refer to as the inventory. So they were saying that inventory level and variable cost are, however, expected to remain constant at 20% and 40%. So that inventory is 20%. The inventory level is meant to be 20%. So it is 20%. It is 20% of. So my explanation to you about the inventory, they are the stock that you have not sold. It is the stock that is in your business that you have not sold. So if you could have sold, you could be having that money, and that money could be in the bank earning you interest. That money could be in the bank earning you interest. But you see, now you have not sold. So there is interest you are losing. That one we also refer to as opportunity cost of the inventory. We shall also be having opportunity cost of the inventory. Opportunity cost of the inventory. Inventory are goods that you have not sold. So because you have not sold, they are lying in your business idly, in idle way. So you need now to know that interest that you are losing. So that inventory was 20% of the sales. So get 20%, 20% of the sales, which are 12, and get 14% of that. Get 14% of that. 336. So it is 336. Also, you come to this other side. It is 20%. 20% off. Also get 14% of that. For 20. So now you can subtract those expenses from the contribution so that you get earnings before the tax. So subtract those expenses from the contribution so that you get the earnings before the tax. So before you are getting out. Sorry? 55.24. Then after
40.50.
So now you less the tax. So tax was 30%. So you get 30%. So what is 30% of 55.24? 1567.2. Or
16.
1657.2. Then also this other one, you also get 30%. So the 14?
13.53.
13.53. You are 50 to 10. So it's 50 to 10. So also get now the tax on that. $15.62. 15.63. So subtract now to get your earnings after the tax. So before the change should be how much? 3866.8. So after the change, you are getting which figure? After 3647. So after we are saying it is 3647. So after they are saying it's 3647. So you see the profit after is less. The profit after it is less. So we advise them not to change the credit policy. So the advice is that the company should not change the credit policy. It should not change the credit policy. It should not change the credit policy, as it will lead to the decrease in the profit. It should not change the credit policy, as it will lead to a decrease in the profit. So get that difference in the profit, always indicate. So take this profit minus this. You always show that decrease. So always indicate that decrease in the profit. So it has reduced by how much? Sorry? 219.8. So always you show that part. So 219.8. So I want us to do another question. I'd also like us to do another question. So May 2016, question number 2, part D. May 2016, question number 2, part D. May 2016, question 2D. So let us check the question for May 2016, question number 2, part D. May 2016, question number 2, part D. May 2016, question number 2, part D. So we check the question for May 2016, question 2D. So are we there on that question? For May 2016, question 2, part D. So the question reads that Matata Limited currently operates with the terms of net 80 days. They currently operates with the terms of net 80 days. So it is on page 62. They say that the firm's average investment in the accounts receivable amounted to shillings 4.4 millions. It amounted to shillings 4.4 millions per annum. 80% of the firm's sales are always on credit. The company is considering introducing terms of 2/20 net 90. 2/20 net 90 days. So the relaxation of the terms of sales will increase the firm's total sales by 60%. The firm's total sales by 60%. So all the cash customers and 40% of the credit customers, all the customers and the 40% of the credit customers will take advantage of the cash discount. Will take advantage of the cash discount. So the average collection period will increase to 80 days from the current average collection period of 72 days. Bad debts are expected to remain at 3% of the credit sales. To remain at 3% of the credit sales. Inventory level are estimated to be 5% of the firm's turnover, and the creditors will increase by 1 million. Gross margin on the sales is 14%. So cost of capital is 16%. The corporate tax rate is 30%. Assume there were 360 days in a year. Assume there were 360 days in a year. So required, advise the management of Matata Limited on whether to switch to the new credit policy. So when you go through that question, the sales were not even. So we need to do some workings. On that area. So in our workings, we want to get the sales. The sales were not given. But the question had given you average debtors. Remember, for you to get the average debtors, it is supposed to be given by the credit sales. Multiplied by average collection. We divide by number of days. So average debtors is supposed to be given by the credit sales multiplied by average collection period. Then you divide by the number of days. So we are simply doing some workings because the sales were not given. The question did not provide for the sales, but the question gave you the average data. So we make the credit sales to be the subject. So when we make credit sales to be the subject, it will be given by average debtors. We take the average debtors multiplied by number of days in a year. Divide by average collection period. We divide by the average collection period. So average debtors were given in the question. Are you able to see 4.4 million? So average debtors in the first paragraph, they say that the firm's average investment in the account receivable are the debtors. That figure is 4.4 million. They gave you 4.4 million. Then they say that we assume there are how many days in a year? So we assume there are 360 days in a year. So average collection period before, it was given separately from the net. Are you able to see in that second paragraph where they say that relaxation of the terms of the sale will increase the firm's total sales by 60%. All the cash customers and 40% of the will take advantage of. Then the average collection period will increase to how many days? 80 days from the current average collection period of how many days? 72. So currently the average collection period is 72 days. So that now should give you the credit sales. It should be able to give us the value for the credit sales. So how much are you getting as the figure for the credit sales? 22 million. Yeah, so that credit sales is 22 million. Then still in that first paragraph, when you still check in the farm, they had said that 80% of the farm sales are always well on credit. Are you able to see 80%? In that first paragraph, they have written there 80% of the farm sales are always on credit. So the 22 million is our credit sales. So we want to get the total sales. We want to get the total sales. So to get the total sales, you say that 22 million is equivalent to 80%. How about 100%? How about 100%? How about 100%? A 100% will give us how much as the figure for the credit total sales? 27.5. Yeah, so that information was not there in the question. That's how to get the credit sales, and also get the total sales. When you get a question provides you that kind of information, that is the format you will go so that you come up with the sales. So now we can prepare our income statement. After that, we now prepare our income statement. So from there, we can now prepare our income statement. So in the income statement, we start off with the sales revenue. We start off with the sales revenue. So before the change, how much was that figure? When you're getting 27.5. It's 27.5. But after the change, they have said that relaxation of the terms of the sales will increase the farm's total sales by what percent? 16%. You can see that second paragraph. So get 160%. 160% of 27,500. 60% of 27,500. Get a figure of 44. So now after that, we less the variable costs. We need to less the variable costs. We less variable costs. So variable cost, there is somewhere that I've given the gross margin. See the gross margin, the same as the gross profit. The gross margin is the same as the gross profit. So they gave you 40%. If the gross profit is 40%, it means the variable cost is 60% of the sales. It means the variable cost will be 60% of the sales. So variable cost gets 60% of those sales. So the gross profit is 40% of the sales, which means the variable cost is 60% of the sales. So how much do we come up with? 16. 500. Also, it will be the same for this above. Also get 60% of.
26 from
So subtract to get the contribution. Subtract to get the contribution. Subtract to get the contribution. The first one is that we learned out. Then key in human capital.
17,600.
17,600. So now we less the expenses. Now that's the expenses. We minus the expenses. So among the expenses, the first one is the bad debts. The first one should be the bad debts. So for the bad debts are expected to remain at 3% of the credit sales. Bad debts are expected to remain at 3% of the credit sales. So we now get the bad debts. Bad debts. So it is 3% of the credit sales. So credit sales, before mnakumbuka the figure, it was 22. $660. Then after the change, you remember the credit sales was 80%. Yeah, so after the change, get 80, so it is 3% of 80% of the 44. Because 44 is the total sales. But credit sales are always 80%. The credit sales are always 80%. So get 80% of 44, and you get 3% of that figure. So that is now for the bad debts. Then apart from the bad debts, so there is also the discount. There is also the discount. There is also discount. So the discount, you can see after 80% in the first paragraph. After 80% of the farm sales are always on credit. So the company is considering introducing a term of what? 2/20 net 90 days. So before it was not there, but after there is a discount of 2%. So when you continue in the next paragraph, they say that relaxation of the terms of the sales will increase the farm's total sales by 60%. Then all cash customers and 40% of the credit customers will take advantage of what? The cash discount. So discount will be divided into two. There will be the cash customers, and also the credit customers. So they were not there under the current terms. They are not there under the current terms. But after the change in the policy, the discount rate is 2%. But they have said that all the cash customers, that's why I'm separating them. There is the cash customers and the credit customers. So the discount rate is 2%. The discount rate is, so this is after it is 2%. So cash customers are 20% because credit is 80. So cash customers will be 20% of 44. Then get 2% of that. Get 2% of that to give you the cash discount on the cash customers. The discount on the cash customers. 376. 176. Then for the credit customers, it is 2%. So credit customer is 80% of 44. But they are saying which proportion of that customer that qualified for the discount. The credit customers is what proportion that qualified for the discount? All the cash customers under 40% of the credit customers qualified for the discount. So our credit customers is 80% of this. But out of that total, only 40% will qualify for the discount. Yeah. So online, I hope you get that part. So get 40% of this. 40% of the credit customers are the ones who qualified for the discount. They now get 2% of that total. So it is giving us it. I hope it is clear to everyone, those who are online. Is it clear to everyone? Is it clear to everyone, those who are online? So apart from now the discount, we go to the opportunity cost of the debtors. We now got the opportunity cost of the debtors. Now got the opportunity cost of the debtors. Opportunity cost of the debtors. So before the change, average debtors were given. So remember the average debtors before the change. The 4.4 million. And the cost of capital is 16%. So before, simply get the 16% of the 4.4 million. Average debtors before were given. Average debtors before were given, it is 4.4 million. So you get 16% of that. Then after the change, so you're not there. So after the change, you need to get those average debtors. You remember how to calculate the average debtors. Average debtors is supposed to be given by credit sales, not by average collection period divided by the number of days in a year. So average debtors, credit sales, it is 80% of the 44. That one will give you the credit sales. Then average collection period, it was changing to how many days? The average collection period will increase to 80 days, up from the current average collection group of 72. So it will go to 80 days. So multiplied by 80 days, divided by 300 and 360 days. So then also get 16% of that. Sorry? 0.51. 125. 12.51.6. Then the next one will be opportunity cost of the inventory. There is also opportunity cost. There is also the opportunity cost of the inventory. There is opportunity cost of the inventory. So inventory, they had said that inventory level are estimated to be what percent? 5% of the farm's turnover. 5% of the farm turnover. So turnover is the same as the sales. So you get 5%. 5% of the total sales. Is it total sales? Yeah, turnover is the total sales. So 5% of 27,500. Then get 16% of that. Then get the 16% of that time. Then get the 16% of that particular value. Sorry? 220. So we do the same after the change. It will be 5%. 5% of the 44. But also get 16%. 352. So this time the question also gave you the creditors. Are you able to see the creditors? There is somewhere the question has given the creditors. So creditors will increase by 1 million. So creditors are people you owe money. Creditors are people we owe money. So because we owe them money, it means that money is in our account. So it is earning you interest. So it is interest received. So you will be adding. We add interest received on the creditors. Remember, creditors are the people you owe money. So you have not paid them. So that means that that money is in your bank earning you interest. So these ones we subtract, but there is an income. We add the interest income on the creditors. So we shall be required to add interest from the creditors. Interest from. So it was not there before, but after they say the creditors increased by how much? 1 million. So you get the 1 million. So our case, I will be using 1,000 because there are 3 zeros at the top. Then you get 16% of that. The interest rate is 16%. So it will be 100 and what? Yeah, so this one's less, but this one will be required to add. Remember, these others you less, but for the interest from the creditors you add, so that you now get earnings before the tax. So do that, so to get now the earnings before the tax. So creditors are people you owe the money. So you have not paid them. If you have not paid them, that means that money is in your account, earning you interest. That's why we are adding the interest on the creditors. So, tumeweza subtract the tax. So what do you have as the earnings before the tax? Hiyo ya kwanza imewapea ngapi earnings before the tax? Sorry?
946.
9416. Na hiyo ingine after the change? 14. 642. Like that. Others, you are getting those figures. Those who are online, are you getting those figures? You give me your values, what we compare. Yeah, most of them they are saying yes. So you are supposed to less the tax. They gave you the tax rate. Yeah, so you are supposed to less the tax. You are supposed to less the tax. Tax is 30%. What is 30% of 9460? 28, 24 points. 92.8. So you get now earnings after the tax. So before the change is how much? Are you in that? 10 to 49. So the advice was change the credit policy. The advice is that change the credit policy as it will lead to the increase. It will lead to the increase in the profits. It will lead to the increase in the profits. Lead to the increase in the profits. So then get that difference to give you that increase. Make sure that you get the difference to give you the increase. Make sure you get the difference, the increase. So finally, let us check the question for November 2019. November 2019, question 1, part B. November 2019, question 1, part B. So we check November 2019, question number 1, part B. November 2019, question 1, part B. So you go to page 31, it is the last question I'm doing on that part. Then we conclude that topic of the working capital management. So that we conclude that part of the working capital management. So when it comes to that question, it reads that is question 1, part B. They have explained that Sasa Limited is considering a review. Of the credit policy as a way of enhancing its working capital management. As a way of enhancing its working capital management. The following information relates to the company. The following information relates to the company. So they gave you annual sales amounted to 6 million. Annual sales, it amounted to 6 million. So credit sales are 80% of the sales. Bad debts average 3% of all the credit sales. Then average collection period for the debtors is 45 days. Gross profit on sale is 75%. The company's cost of capital is 12% per annum. Then they have also said that terms of credit are net 60 days. The company's credit manager is recommending a review of the credit policy of the company. The expected outcome of this action will be, so increase in total sales by 14%. There is also credit sales will be 60% of all the sales. Average collection period. Average collection period will decrease by 30 days. Bad debts will increase by 5% of the credit sales. Additional part-time credit consultant will be hired at a 500,000 per annum. Gross profit margin will increase to 80%. So they also gave you the credit terms. Terms of credit sales will be 5/15, net 45. So 5 is the discount rate. Then all credit customers will enjoy the 5% cash discount. No change in them is expected in the farm cost of capital. Tax rate will be 30%. So required, advise the company on whether to adopt the revised credit policy. So we just prepare the normal income statement before the change and also after the change. So that question should take the shortest time possible, because now you know how to deal with those type of questions. So you start off with the sales. Revenue. So sales revenue before. Are you able to see before annual sales? It is 6 million. But after we check down there, they have said that increase in the total sales by what percent? So get 40%. We get 40% off. That's 8.4. So we less the variable costs. Variable cost before the change You see, they gave you the gross profit on the sales before the change. The gross profit is 75%, which means the variable cost is what percent? 25%. So you get 25%. So it should be how much? So this one. Then also confirm the gross profit after the change. The gross profit after the change, gross profit margin will increase to what percent? 80%, which means the variable cost is what percent? 20% off. 1680. So I'll get the difference to give you the contribution. Get the difference to give you the contribution. So before the change, what is our contribution? After the change, 67. Now we less expenses. Now we less expenses. So among the expenses, so this time there is bad debts. There is bad debts. There is bad debts. So bad debts, they have said that bad debts will average 3% of all. So we assume all the sales were on credit. No, sorry. Credit sales are 80% of the sales. So get 3% of 80% of this, because before they change, the credit sales are 80% of all the sales. So get 80% of that figure, then get 3% of it. 144. Then after the change, the bad debts is what percent? 5% of the credit sales. So credit sales is what percent after the change? 60%. Mono your 60%? Yeah. So get 60%. So apart from that, there was someone who was a salary, but that is after the change. Are you able to say that additional part-time credit consultant will be hired at how much per annum? Yeah, so that is the salary. But before he was not there. He was hired after the change. When he was hired, he was being paid 500,000. Then, apart from that, now there is the average, the opportunity cost of the debtors. Opportunity cost of the debtors. So first you calculate the average debtors. To get the average debtors, credit sales multiply the average collection period divided by what? Number of days in a year. So credit sales is 80%. Of the sales. But before the change, the question had given the average collection period, 45 days. So we assume there were how many days in a year? We assume there are how many days in a year? Have they given, if they don't provide, assume there are 365 days. If they don't provide, always assume there are 365 days. 365 days. So that cost of capital is what percent? So the cost of the company's cost of capital is what 12%. Yeah. So when you multiply 12% is when you get. It's exactly 71. 04. 71.01. Then after the credit sales was 60%. So 60% of 84. And after the change, what is the average collection period? So you are able to give you 30 days. So we assume there are 365 days. So you also get 12%. That because it did not change. 49.71. Then apart from the opportunity cost of the debtors, the question also had discount. It had a discount. But the discount was only there after. Before it was not there. But after, kuna mahali wamesema terms of credit sales will be 5/15 net 45. That is what will be the discount. So before it was not there. But after, that discount rate is 5%. But they are saying that all the credit customers will enjoy the discount. Credit customers are the 60% of 84. The credit customers will be the 60% of 84. Then you get the 5% of that. Get the 5% of that. So there is no other expense. There is no other expense that was given in that question. So get now the earnings before the tax. You get the earnings, so subtract expenses to give you the earnings before the tax. Then you also less the tax, so that we get the earnings after the tax. So I had sent some notes to the class group, the dividend policy. What is the honor? I gave you the notes. Okay. So there are some notes in the class group, the one for the dividend policy. When we finished, we have finished now this topic for the management of the working capital. So in our next class, we shall start on the dividend policy. In our next class, we shall be able to start on the dividend policy. But this one you need to advise whether to change or not to change the credit policy. So confirm whether we should change or we should not change the credit policy. So are you changing the credit policy? Because the profit has gone up. Yeah, so you always advise and give them that increase in the credit, increase in the profit. So we stop there. When we meet tomorrow, we shall now start on the dividend policy. Then we see whether we can finish it so that when we meet again, we start another topic. So we can stop there for today.